chat. Got it, right, Palak?
Welcome everyone to the webinar on the budget. I'll just brief a little about RAI and then we can quickly proceed to the session. Retailers Association of India is the unified voice of Indian retailers. It works with all the stakeholders for creating the right environment for the growth of the modern retail industry in India. It's a premier body of retailers in India, having around 14,000 member establishments. It includes large and small retailers in the country. We represent 500,000 retail stores and provide direct and indirect employment to around 50 million Indians. So I welcome the EY team and thank them for sparing time out of their schedule to address the members. Mr. Sanket Desai, he is the partner with the EY Indirect Tax Practice. He's a chartered accountant by profession and a commerce postgraduate from Mumbai University. He focuses on the consumer and the retail sector, and he has more than 18 years of experience. Mr. Rahul Kakkad, he's also a partner with EY Direct Tax Practice. He's a chartered accountant and a commerce graduate from Mumbai University. He also focuses on the consumer and the retail sector. He has more than 17 years of experience. Mr. Tarrung, the third speaker for the day, he has 13 plus years of work experience, of which over a decade with EY. He has been an integral part of key EY projects, including preparation of the memorandum to the 15th Finance Commission by the government of Jharkhand, revenue gap analysis for Odisha, Chhattisgarh, Jharkhand, and the estimation of the impact of GST on the Indian textile industry. He's also authored several research articles that are published in leading peer-reviewed journals. He is the co-author of EY Economy Watch. Thank you so much, EY team. Over to you, Mr. Sanket.
Thank you so much, Palak, and thanks a lot to the Retailers Association of India for giving us one more opportunity, like every year, to interact with all the members and also share our insights and perspective on the interim budget 2024. We take this opportunity to to also discuss what the government has been doing in terms of their mission for Vikasit Bharat, which is the goal by to be achieved by 2047, and also certain recent tax updates, more specifically GST updates. As you all would be aware, in the last few months, there has been a lot of action from the side of the department, as well as litigation. Some very interesting judgments have come in, and a lot of articles have come in on notices being issued to many companies, so on and so forth. And what we have tried to do in this session is to kind of filter down and identify certain important points which could be relevant for the entire retail sector. So that's what we want to achieve in this session. So we start with the first part, which is the key policy announcements. So, I mean, just to give a broad overview of the overall budget, what we are trying to say is that this budget to start with was not the union final budget like every year, but this was an interim budget, and this was mainly because of the fact, as you all would be aware, that that there will be general elections in this year, and as a process, there has to be an interim budget. The final budget will come in again in the month of July 2024. So that's the opening statement. But having said this, there have been certain important announcements in this budget as well. Uh, The first and most important point, just to give you a broad level idea, in the next 2-3 minutes, I will just try to cover the highlights of this budget, and then we will dive into the specifics of tax updates, so on and so forth. The first important point was that there will be there has been an increased focus and continued focus on capex expenditure. If you look at the last year, almost 33% increase in the budget for capex had happened in the last budget itself as compared to the previous years. Uh, this year, we can see that there has been a further increase in that budget by another 11%. So definitely the focus continues to be on capex. Last year, the spending was around 10 lakh crore. This year, it is around, the estimate is around 11 lakh crore. Out of this, I mean, as you can see, one of the major focus areas is railways. Uh, and this consists of two broad categories. One is the freight corridor that they want to establish. So they are looking at developing three major rail corridors. One is relating to energy, mineral, and cement sector. Second is the port corridor, and third is the high density traffic corridor. They also announced that 40,000 rail bogies will be converted to Vande Bharat standards, which is good news for us. So that is one theme which definitely the government is committed to. The second important announcement is with respect to focus on new energy. Yes, rooftop solarization continues to be one of the focus areas where we want to we reduce our reliance on conventional energy sources and increase the use of renewable energy. 1 crore households to obtain up to 300 units of free electricity every month. That's the target. Uh, yes, coal gasification, liquefaction, phase blending of CBG and CNG transport. So all those efforts and proposals are with respect to the new energy agenda. The other aspect was the focus on also, I mean, as agri sector. So one is when we talk about agri sector, there is this oil seeds abhiyan which has been introduced, where the focus is that uh, the the idea is to reduce the import of edible oils from 60% to 30%, so that India becomes self-reliant in oil seeds such as mustard, groundnut, soybean, and sunflower. So this is going to impact, or this can be an opportunity for the food sector, more specifically edible oil sector, where the focus again will be on Make in India and reduce dependence on imports in this sector. The other area is increased focus on funding for central universities, learning universities, including research and innovation universities. So some additional funding has been proposed for research and innovation, definitely. So that is the other focus area here. Apart from that, in the healthcare sector, expansion of Ayushman Bharat cards, which are issued to the lower middle class section of the society, or even middle class section of the society. More investment in cervical cancer vaccine, right? If we talk about the overall progress card of this government, what we can look at is that I mean, there are two aspects. One is the fiscal deficit, which is one of the indicators, how the budget estimates versus actuals has happened. The fiscal deficit has been gradually reducing year on year, which is good news. The target for the last year to be achieved was 5.9% of fiscal deficit. The government seems to have achieved that, and in fact, they have overachieved it. The fiscal deficit estimate for this year is 5.8%, and the target for the next year is 5.1%, and the aim is to reduce it to 4.5% by 2026. Also, the larger aim is to reach to become a $7 trillion economy by 2030. And the GDP, if we talk about the GDP percentage, the real GDP is estimated at around 7.3%. which is also almost in line with estimates given by a lot of international associations, including IMF, World Bank, OECD, RBI. I mean, include even RBI for that matter. They have also estimated GDP percentage of around 6.5 to 6.7%. So this was a quick snapshot of what has been announced in in this budget, is this interim budget. Now we will go to the indirect tax part first, the indirect tax proposals. As you would imagine, no major changes or amendments have happened with respect to indirect taxes. One of the major, I mean, the reason for that was that, I mean, whenever there are changes in GST, there is a mechanism for any change in the GST rate or even the GST law. It has to go through the GST Council meetings, and it has to be approved by the GST Council, and then the approval, then the change happens. And that's one of the reasons why in the budget there are generally not any many announcements with respect to GST. However, they have tried to deal with one important issue in this budget, which could be relevant for all the members. There was always this debate about input service distributor, or ISD, as popularly called under the GST law. Whether ISD is mandatory. There were many companies who were not doing ISD, or some companies who were doing ISD. I mean, ISD is basically distribution of GST credit, which is received at the head office for all the common input services, let's say, such as audit fees, consultant, legal fees, all the common entity level expenses which are received at the head office, whether the GST credit needs to be distributed to other states. That was the debate. And there was always a provision of input service distributor, or a mechanism which allows distribution of this credit in a certain manner of calculation. However, some companies had taken a stand that this is not mandatory. Some companies, instead of doing ISD, were doing cross charge. So there was a lot of ambiguity and different practices being followed. In the 50th GST Council meeting, which happened a few months back, after a lot of deliberations and a lot of representations made by trade, the GST Council finally decided that we should put a rest to all these ambiguities and debate with respect to ISD. So they made recommendations in this 50th GST Council meeting that from now on, input service distributor mechanism, uh, we should clarify that it should be mandatory for everyone so that there is uniformity, no cross charge, only ISD. That's what was discussed and agreed in that meeting and recommended. In line with that recommendation, what they have tried to do is that they have made it mandatory. So now every company who has a head office and receives common input services, or any office for that matter, which receives common input services, which is pertaining to other GST registrations within the same legal entity, will be required to distribute the GST credit as per the ISD mechanism, and that will be a mandatory requirement. Whoever have not taken ISD registration should take a GST registration, ISD registration for that. Uh, the action point here is to verify and to check whether the process is in place for our own company with respect to ISD. We should identify the expenses which are incurred at head office or any other admin office, whether those expenses are common, whether those expenses are pertaining to a particular state or a particular registration, and identify those expenses, identify those vendors, inform those vendors that from now on they should raise invoices on my ISD registration rather than the normal GST registration. And from there, the GST credit then should be distributed to other GST registrations as per the ISD mechanism. They have also said that the basis of distribution will be prescribed through rules at a subsequent date. Right now, the basis of distribution which is prescribed under law is based on the turnover ratio of the previous year. But that was mentioned in the Act itself, the GST Act. Now they have said that it will be done. I mean, they will prescribe this mechanism separately through rules. So there may be a possibility that there may be some change, some minor changes in the mechanism for distribution. What should be the methodology or calculation for distribution? And this change will be effective only when only from a date to be notified. So it's not immediately effective. Uh, so the rules will come, the change will be effective after the notification. But right now, all companies will need to be aware and will need to gear up for this change. Another important point was that even reverse charge related invoices, reverse charge means where the company pays GST as a receiver under reverse charge mechanism, where vendor does not charge me GST. There are some services where reverse charge mechanism applies. So they have also clarified that ISD will cover reverse charge also, which means even reverse charge related invoices, services would now need to be distributed through the ISD mechanism. So that is one important change. It is impacting not just the retail sector, but all the sectors across sectors. So that's change number one with respect to indirect taxes. There is also one more minor change, and this is not impacting everyone, but maybe impacting certain manufacturing companies who are engaged in products such as tobacco or related products. Uh, so there is a requirement even today under the GST law that for certain products, certain specific products like tobacco and tobacco related products, certain packing machines are required to be registered with the authorities. I mean, you need to inform the authorities that what is the list of machinery and registration. Now they have said that if you don't register, okay, then there will be a penalty. There could be seizure, so they can seize the packing machines as well. So they have kind of brought in the provision to enforce this requirement through penalty and search and seizure kind of provisions. So this is the other amendment. We can go to the next. That was about GST. When we go to customs, when we look at customs, again, no changes made in the budget with respect to customs duty rate. The standard rate of custom duty continues to be 10%. Now, it is very important to note that like GST, even under customs, the changes with respect to customs rates happen during the year, I mean, throughout the year. So we keep seeing notifications once in a while, I mean, maybe 15 days, once in a month. They keep issuing notifications for changes in the GST rates. If we notice the trend just prior to this interim budget announcement, in between 15 January to 31st of January, there were some changes which had already been announced with respect to customs. The first change was basic customs duty on certain inputs, parts, assemblies of cellular mobile phones was reduced from 15% to 10%. So this announcement did not happen on the budget day, but it happened just on the just about 5 days, 4 5 days before the budget day. Also, certain customs exemptions which had a sunset clause, the validity of those customs exemptions has been extended by 6 months to 30th of September. This is merely because they want to give more time till the final budget comes in the month of July. So they don't want to make any major changes with respect to customs duty exemptions at this stage because this is a interim budget. Another announcement which happened was that for the export incentive scheme, which is for ROTTEP or remission of duties and taxes on exported products, they have increased the allocations, the budget allocations for this scheme, which means that uh, there could be, I mean, higher amount of duty credit scripts or export incentives which could be allowed for the trade and for the companies, exporters from India. Also, the ROSCTL scheme has been extended till 31st March 2026. So these were the announcements with respect to customs duty. Now we will go to the next phase. So what do we expect in July to happen or in the subsequent months with respect to GST. One is, of course, simplification of the legislation. Now we have completed 6 years after introduction of GST. So it is good time to take stock and also take, suggestions from the industry, and if there are any changes, tweaks to be made in the GST law to simplify the law. Uh, so that effort continues, and some changes have already been done in the last few years, and that effort continues. So one agenda is clearly on simplification of the GST legislation, simplifying the provisions. One effort relating to that has already been made in the form of a clarification on input service distributor. They also want to rationalize the credit regime. Today, the GST input tax credit regime has a lot of still has certain ambiguities or certain leakages. Certain credits are not available. Okay, so that is expected to be rationalized further. Rate rationalization is something that everybody is looking up to. As you all know, today there are broadly, there are five rates, if I may say, or four rates, if we exclude the exempt product. But otherwise, it is 5, 12, 18, and 28 are the four broad categories. There have been discussions earlier also on merging 12 and 18 into a single rate. So they want to keep a lower rate of 5 for certain essential product and standard rate of 18 for most of the products. But they wanted to basically merge 12 and 18 into a single rate. So that is also one of the agendas which we can look forward to. Of course, this amendment could not have happened in this interim budget, but this is definitely on the agenda for the government.
These are quite lightweight, quite effective,
The other amendment or expected change is with respect to managing controversy, because now you know that GST litigation has picked up a pace and it is now gone into from first gear to fourth gear. And in the next 6 months or 12 months, it will again go to the fifth gear. Uh, so one urgent requirement and need of the industry now is to finally have a tribunal in place. As on date, we do not have a tribunal for GST. So most of the cases which have been adjudicated at the first level as well as the first appeal level, the commissioner appeals level, uh, they are all waiting for the tribunal to be formalized and the bench to start functioning because they need to file appeals. There are many companies who have pending litigation still, and they have kept their appeal filing on hold because the tribunal is not yet formed. Uh, so in the next, there have been articles very recently where they have said that in the next few months, the GST tribunal will start coming into force. The next point on managing controversy is centralization of audit and assessment framework. So yes, right now, most of you would have received notices from state authorities, central authorities, different authorities, even DGGI, multiple authorities and wings issuing notices, right? The idea is to centralize the audit and assessment framework so that the number of notices is reduced. There is a single window kind of a clearance for assessments and audits. That is also one of the agenda points. And last but not the least, dispute settlement scheme. There are many disputes which have come up in GST. One of them is GST on secondment of employees after the Northern Operating Systems decision of the Supreme Court of India. Similarly, there have been other disputes as well. So they want to, we can expect in future that some kind of a dispute settlement scheme may come in. They may even come up with a one-time amnesty scheme for the first 2 years, maybe 2017 or 18. That also may happen. So all those points are under discussion. Right now, if you have seen, notice most of the states have already announced VAT amnesty scheme. So VAT was prior to introduction of GST, there was VAT. So that has already been announced. So they wanted to clear the old pendency pre-GST. And most of the amnesty schemes will expire under VAT in the next 5 to 6 months. And once that happens, the next focus area will be clearly GST. As far as customs is concerned, duty rate rationalization simplification is the agenda. Again, dispute settlement scheme, improved footprint of AEO, authorized economic operator, to reduce the customs clearance time, to further have ease of doing business as far as customs is concerned. Continued enhancement of FTA, free trade agreement coverage. Most of you would have already seen articles and news with respect to India UK FTA discussions which are going on right now between the government of India and the government of UK. So that will be one important aspect to watch out for, because this can open up one more corridor for import of goods from UK to India, as well as export from India to UK, including consumer products, even uh, alcohol products and all those products. So in a continued enhancement of FTA. The government is also focusing on technology. So they have already developed a state-of-art system to track all the import transactions, export transactions, and they want to take it to the next level by having automated trade interface system, which is under development right now. The idea is to secure a more favorable position in the global trade rankings and improve the efficiency of the customs function. So that is clearly the exam agenda. Yeah, Ruchita, we can go to the next. Okay. Now we'll just cover the recent updates that have come with respect to GST. And this is not budget, but this is pre-budget. So the idea was to apprise you and take you through the important amendments that have happened in the last 4 to 5 months. So this is the gist of that. If we look at the recent trends, clearly the authorities have been initiating notices subsequent to amendment related to laws after Supreme Court rulings. So many companies have received a lot of notices, a lot of audits have got initiated, which was absent till last year. This activity has taken up real pace only from, let's say, July or August of 2023. Authorities have started issuing summons, personal penalties to individuals as well. So that has also taken up a lot of pace. Detailed review by tax authorities through state level audits using data analytics. This is one trend which we can clearly see, where the department is also making use of technology, because they have all the data, right? When we issue any or generate any invoice, we generate a QR code and an e-invoice, and the real-time data goes to the government portal. So the government actually has everything, all the transactional level data of pan-India companies. And they are the idea is to make use of that data through technology. And so that is one clearly one trend which we can see, that the assessments have intensified and use of technology in assessment, which takes us to digital tax administration. What are the key litigation issues which we can see? One is tax liability on secondment of employees. So many consumer and retail companies have received notices on secondment. So there was one Supreme Court decision in the case of Northern Operating Systems, where they said that if a foreign company has, if let's say we have taken an employee from our global overseas company on secondment, and even though that employee is on the rolls of the Indian company, and we are paying him salary, and we are also issuing Form 16, treating that person as an employee for all practical purposes and legal purposes. Still, if that employee has been seconded, or if he still has a social security number abroad, then there is a possibility of GST being applicable on the amount that we pay to the foreign company. So this will be still treated as a service. So this issue has blown up, and a lot of companies have received secondment related GST notices, and the litigation runs into hundreds of crores for many large companies. A lot of news articles have happened on this. The other important change or litigation area is with respect to corporate guarantee. So if we are giving a corporate guarantee in favor of, let's say, a subsidiary company or a group company to the bank or to any financial institution. Okay, and this is a very general practice where a holding company gives a corporate guarantee for its subsidiary company. Now they have clarified that if you are doing that, then this will be treated as a service, and 1% of the corporate guarantee amount will be treated as the value of service. So which means GST has to be paid on the corporate guarantee related service. So we have to be really careful and watchful that if we are signing any corporate guarantee or any guarantee for any bank on behalf of our group company or any subsidiary company or any other company, then there could be GST implications on that. Tax liability on account of credit note disallowances, sales return discount is another area where a lot of litigation has happened. Tax liability on account of samples or gifts given. So in the retail industry, there are a lot of schemes, right, where they issue, I mean, buy one get one free, or a lot of schemes for the retailers with respect to if target based incentives. If they achieve certain targets, then they get certain holiday packages or gold schemes. I mean, all those schemes have come under the scanner. There are some interesting advanced rulings also on this topic, but many companies have received notices with respect to input tax credit taken on such goods which are issued under such schemes free of cost. Input tax related to civil construction, again, very important area for the retail sector. Because in our sector, there are always cases of increase in the number of retail stores, renovation of our existing retail stores, and civil construction. I mean, if there is any civil construction for those stores, the input tax credit on those is not allowed under the GST law. There is a specific restriction. And litigation has already started on this. The authorities are scrutinizing our purchase registers. They have already identified the vendors, or they know the GST numbers of those vendors who provide civil construction related service, and they are doing those very specific and pointed audits, keeping civil construction as one of the focus areas. Interesting to note that on civil construction, all of you would be aware that there is one High Court decision in the case of Safari Retreats, which says that for a shopping mall, right, which is constructing its own shopping mall and then giving those units on lease to third-party shops, the GST credit on civil construction should be allowed. Okay, so that was a favorable High Court decision, and that has been challenged by the department before the Supreme Court. The hearing before the Supreme Court has already happened, and the judgment is reserved in the month of October 2023. And now additional submissions may be filed, and in the next couple of months or few months, most probably we are going to see the final decision on civil construction. So it will be important to evaluate the strategy or the input tax credit position taken by the company in the past in light of this judgment on civil construction for Safari Retreats, which is expected in the next few months. Of course, reconciliation issues of GST are 1 versus 3B. All those issues are low-hanging fruits or easy pickings for the department. So that trend continues. Other litigation in areas include irregular transition of credit, fraudulent availment of input tax, mismatch in turnover, statewide GST and maintenance of books, right? So all these are we have tried to list down the top 7, 8 litigation points which most of the companies, 80 to 90% of the companies are facing today with respect to GST in the last, and these are all notices which have been received in the last 4 to 5 months. Yeah, Rajit, I can go ahead. Recent changes, some procedural changes have also happened. Now they are saying that taxpayers whose annual turnover is more than 5 crores are required to provide 6-digit HSN code. This may or may not impact all of us because most of us may be already more than 5 crores. But if we are dealing with small vendors whose turnover is less than 5 crore, and if they are still issuing us notice invoices with 4-digit HSN code, then we need to tell them that from 1st February onwards, they need to mention 6-digit HSN code on their invoices. And if they don't do that, then in future, the authorities can raise questions on this. There could be notices which we will receive. They may say that input tax credit is not available because the invoice does not carry 6-digit HSN code. So this is one important point to note for us. I mean, to inform all our small time vendors. From 15 December 23, taxpayers with turnover again more than 5 crores will have to submit at least 6-digit on their e-invoices as well. So this is a consistent change. GSTN has enabled GST payments through credit cards, debit cards also. So that is one facilitation amendment which has happened. On secondment, we already discussed about this Supreme Court decision in the case of Northern Operating Systems. What happened after this is that many companies, many large companies, medium scale companies received a lot of notices on this. And many companies, I mean, the department tried to initiate recovery as well. Bank account attachments also happened. So there was obviously there a lot of companies went into writ petitions against this issue. And the taxability, high courts have now held that I mean, in fact, there was a very recent decision which has come only 3-4 days back, which says that with respect to secondment, the proceeding should be stayed till the issue is settled. So the recovery should not be made. Even the CBIC has issued a specific circular on this particular issue. In the last month itself, where they have said that uh, recovery cannot be done just mechanically. It should be applied, should be done very, very judiciously. We have to look at each and every case. You have to evaluate on a case-to-case basis. Then only you can take the next step. So just blindly applying the Supreme Court order of Northern Operating should not be the right way. So even the CBIC has given those instructions to everyone, to the entire department on this point. Yeah, Ruchita. Corporate guarantee also we discussed that they have brought in a provision that it shall be 1% of the total amount. Another important point to note, and this amendment happened only last month, that for assessment of the years 2017, 18, 18, 19, and 19, 20, they have been extending the due dates for completing the assessment for the department. The initial extension was on account of only COVID, wherein for a good part of almost 2 years, from March 2020 till March 2022, most of the offices were closed, even department offices were closed. And that's why the Supreme Court even passed an order, and the CBIC also issued notifications that for counting the limitation period, those 2 years of COVID will not be counted. However, now they have done further extension. So if you see for 2018-19, uh, the last date for issuing a notice actually was 31st December 2023, and the last date for issuing a order was 31st March 2023. Now they have extended it by further 1 month. And this amendment has happened just now in the month of January itself. Similarly, for 2019-20, the last date for issuing a notice is now 31st May. Earlier, it was before that, and even the time limit for issuing the order is now 31st of August. So both these extensions have happened. Uh, and there are companies who have even challenged this. They have said that this has been done under a particular section which allows this only in case of force majeure. Force majeure means if there is any calamity, natural calamity, only in those cases such extension should be done. uh, COVID was a force majeure situation, but now there is no such compelling situation. So there are companies who have challenged even this 1 month extension and saying that this should not be just extended to give more time to the department to issue notices. Some compliance related changes have happened. This is another important point to note for all of us, that now the department is tracking your GST return every month. What they do is that how much ever credit you have taken, input tax credit you have taken in your monthly return of GSTR 3B, that should not exceed the GSTR 2A. 2A means what your vendors have uploaded on the government portal. So let's say the GSTR 2A credit is 100, and if you have taken 110, then you will automatically receive a notice immediately after filing the return that you have taken excess credit of 10 rupees. And then you have to give a reply to that within the next 7 days. There could be valid reasons for that, for the difference, but we need to give that response and explain. If this is not attended, or if this difference continues and we don't file a reply, they have the powers to even freeze your GST return for the subsequent month. So in the subsequent month, then you will not be able to file returns if you don't file a reply to this notice. So it is very, very important now to track the notices. And I want to highlight this to everyone, that in many cases, these notices we will not receive on emails, or we may not even receive physical copies of these notices. These will be uploaded on the GSTN portal. And I'm aware of companies, and I have other clients who have kind of missed this looking at these notices, because a notification doesn't come. I mean, you don't get a push notification. You don't know when the notice was uploaded. We have to go and visit the portal and check whether notices are there or not. So we need to be very careful about this. Our tax teams should be informed that they should check regularly the GSTN portal for any notices uploaded on the portal. Yeah, we can go ahead. The last section for indirect taxes was with respect to the judgments. So I've tried to share some important, I've tried to select some 3-4 judgments which could be of relevance for us. One is that this judgment is in the case of Hindustan Unilever Limited, wherein they have said that if you are issuing a credit note for a discount, which is also a very common transaction in the retail industry, under law there is a requirement that I am eligible to issue a credit note only when my customer has reversed the input tax credit. That is a requirement. However, in the GST law, they have not given any mechanism, or as a seller, the person who is issuing credit note, I am in no position to verify or check whether my customer has actually reversed the input tax credit. So the writ petition was filed before the High Court saying that how do we even check this? How does a company check this? What what is expected from a company to ensure that they comply with this provision? Because we don't have visibility on what my customer has reversed. So this has gone to the High Court. The High Court has given initial observations that the department should come up with some mechanism to enable the companies to enforce this. So basically, like they issued a circular for input tax reconciliation to get CA certificates for reconciliation. Similarly, something may be expected on credit notes also in the near future. So that is one. I mean, the final judgment is still not out, but this will come in the next few months. But right now, they have informed the department that they should come up with a mechanism. The second part is Madras High Court decision, where they have said that if you have paid some tax, but you have not, it is just lying in your electronic cash ledger, but you have not adjusted against your GST liability. So there was a dispute on whether interest applies. Suppose today you have deposited 1 crore of tax on the government portal, but it is lying in the electronic cash ledger, but you did not file the return, let's say. So it never got adjusted against your liability. There, the authorities or the viewpoint coming was that from today till the date of filing return, you still have to pay interest. Suppose you file return after 1 month, interest of 1 month applies even though the tax has been paid today. Okay, but now we have a High Court decision which says that once tax is deposited in the electronic cash ledger, then interest cannot be recovered because government has already got the revenue. Although adjustment has not happened, but still the money is already with the government, so interest should not apply. On the input tax credit mismatch, there have been multiple High Court decisions. The latest one is the Supreme Court order, which upholds the Calcutta High Court verdict that if there is an input tax credit mismatch, only the buyer should not be held responsible. The supplier also is equally responsible. So the department officer is first required to carry out certain procedures, make an effort to recover the tax first from the supplier, and only then he can come to the buyer. Simply coming to the buyer and disallowing the input tax credit is not the right process to be followed. So this is also important decision. Another important decision is on anti-profiteering. With respect to anti-profiteering, there were companies who had challenged the constitutional validity because a lot of consumer and retail companies had received notices on anti-profiteering. The government has said that and in the anti-profiteering investigations, they were quite intense, and lot of data was asked, a lot of analysis was done, and many companies had a point of view that the scope of anti-profiteering has been expanded beyond what was initially perceived to be. So the court has said that yes, there may be cases of arbitrary exercise of power under anti-profiteering mechanism by enlarging the scope. So that definitely can be challenged. If you are enlarging the scope, the department cannot do that. However, to say that anti-profiteering provision itself is unconstitutional, that is not the case. So government has said that anti-profiteering provision is very much constitutional and it is valid. Anti-profiteering basically means that if there is a GST rate reduction or a input tax credit increase, then we need to reduce the price for the consumer. That benefit should be passed on to the consumer. And if you don't do that, then it is deemed that the company is doing anti-profiteering, which means we are pocketing that benefit of tax reduction, which otherwise should have been given to the consumers. Uh, On gift vouchers, another welcomed decision which has come is that they have said that gift vouchers which are given are not goods, they are just actionable claims. So this is relevant for the retail industry, I mean the shopping mall industry and all, where gift vouchers are issued, right? So gift voucher per se is neither goods nor services. Only when the gift voucher is redeemed by any consumer who visits the store, then GST applies on whatever he buys. But if a gift voucher is issued on that, there is no GST because it is only actionable claim. With respect to gold coins and white goods, I mean, which are under consumer and retail offers for target-based incentives and all, they have basically clarified that I mean, this is again a advanced ruling, and it basically says that if you are issuing any target-based related benefits to your customers for achieving targets, then you should pay GST on that because it is not free. It is basically fulfillment towards fulfillment of certain targets, and at the same time, you should be eligible for input tax credit as well. So this is also one of the advanced ruling which has come. Yeah, so these were the key updates, budget proposals, as well as the recent developments with respect to indirect taxes. I hope that you would have found this section interesting and relevant for all the members. I now pass on to Tarung, who will take us through the macro fiscal perspective of this budget. Hi, Tarung, you can proceed.
I, a very good morning to everyone. One of the typical headlines of the day on the day after the budget read budget high on confidence, not on populism. In this session, I will be joined with my by my colleagues Ragini and Murli, and I will be taking you through the macro fiscal contours of the budget, attempting to discern its underlying theme and what it implies for the Indian macro economy. Now, in this slide, I would like to draw your attention to the chart on the right, which depicts India's recent growth history. In recent years, growth has been very much dependent on the stimulus given by the government, which has been focused on capital expenditure. The point where Indian economy went through a trough, you can see that in the year of COVID, FY21. After that, it started to pick up. Now, the first year shows a relatively high growth at 9.1%, largely because of the low base effect. But after that, growth appears to have stabilized at just above 7%. The budget does not spell out a real GDP growth estimate, but it only provides a nominal GDP growth estimate. Hence, we use the 7% growth estimate for FY25 as provided by the Economic Review, which was released by the Union government a day prior to the Union budget. Now, as per this review, we are headed towards maintaining a 7% plus growth in the medium term. The real GDP growth here in this chart, as you can see, is represented by the lower or the yellow colored line. Now, the question that is being asked is that was being asked is whether fiscal consolidation would be given a higher priority and some growth would be sacrificed. Now, if this 7% growth is delivered in FY25, as projected by the Economic Review, combined with a reasonable level of fiscal consolidation as projected by the, suggested by the budget, our assessment broadly would be that this is a budget establishing a very healthy balance between fiscal consolidation and growth. Now, the growth estimates as per the first advanced estimates of FY24 are given in the last column in the table on the left. What you can see on the top is looking at the demand side, we see that the top two rows indicate private final consumption expenditure growth and government final consumption expenditure growth. Now, both these, as you can see, are just marginally above 4%. So therefore, growth push is not coming from the consumption expenditure side. In fact, private final consumption expenditure has been adversely impacted by low agricultural growth and high food inflation, which has led to subdued rural demand. So the push to growth is therefore coming from investment, and investment is indicated by the third row here, which is GFCF or gross fixed capital formation. Now, investment is acting as the growth driver, and by showing a growth of close to 10.3%. Now, behind this investment is a massive growth push that is being given by the central government's own capital expenditure. So, and we shall elaborate on this as we move on. So there's a clear link that can be established between India's overall GDP growth and government's push towards the structural shift towards capital expenditure, which has happened in recent years. Now, the adverse part of demand side is that export growth, as you can see, is limited to 1.4%, while import growth is still relatively higher at 13.2%. So therefore, together, when we see both these, the contribution of net exports to growth is at a historical low of minus 3%. Now, that represents the impact of the global economy on the Indian economy. Now, this needs to be negated by the domestic demand, by a domestic demand push, which needs to come in from capital expenditure. Now, the lower part of the table indicates the balance between the output sectors. And here we see that some of the important sectors have shown very robust growth. And these include sectors like construction, trade, and two service sectors, trade, transport, storage, communication, and financial services sectors. In fact, what we see is that barring agriculture, nearly all other sectors have performed relatively well. So we've had a more or less balanced growth in FY24. Now, if we move on to the next slide, the top left table here shows real GDP growth at 7% and nominal growth as given by the budget at 10.5%. With both these numbers, we can work out the implicit price deflator based inflation at 3.3%. Now, the question that arises is this a realistic number, or is this something is there some underestimation in this number? Now, from the previous chart, from the chart in the previous slide, what we saw was that IPD based inflation in this year is estimated at 1.4%. So the derived IPD based inflation for FY25 comes to 3.3%, and that number is significantly higher from this year's 1.4%. But the issue is that this could be even higher, and the higher it is, the better it will be for the Indian economy, because it will contribute to overall tax revenue growth as well. Now seeing the chart on the right, if we place India in the global context, India appears to be doing very well, not only in terms of our own estimates, but also in terms of estimates of other multilateral agencies. And here we have given numbers as per the IMF. So as per the IMF numbers, which were released just last week, although growth in FY24 and 25 is projected at slightly lower levels at 6.7 and 6.5% in FY24-25, it is still more than twice the global growth rate for these 2 years. Therefore, clearly, we are established as a global growth leader by all multilateral agencies and institutions. Now, given this growth perspective, we now move on to the fisc. Can we move on to the next slide? Yeah. Now, here we have a picture of tax revenue growth and prospects, and we see that FY24 revised estimates as compared to the actuals of FY23 in terms of gross tax revenues is estimated at 12.5%. In FY25, these are brought down marginally to 11.5%. The reason for this reduction is a reduction in the buoyancy of gross taxes that you can see in the lower part of the table. From a buoyancy of 1.4 in FY24, the buoyancy is taken down to 1.1 in FY25. Hence, in both nominal growth and buoyancy estimates, we may just be in for a positive surprise, since these numbers appear to be conservative. If anything, our fiscal position would improve as far as center's gross tax revenues are concerned. Now, let's look at the tax GDP ratio, which is there on the next slide. And there appears to be some good news here as well. In the last column, we have confirmed data for combined tax revenues, including states and center. Now, FY22 and 23 show tax GDP at close to 18%. If you look at the long-term history of tax GDP ratio in India, it has languished between 16 and 18% for the last 30 years, averaging at around 17%. So this shows a clear improvement in the post-COVID era. We are not giving here numbers for FY24 and 25 since we don't have those official numbers available from the states as of now. But going by trends, in the recent trends, the combined tax GDP ratio appears set to cross the 18% threshold, and that augurs very well for India, and it's very good news for India's fiscal management, in the sense that in more than 30 years we would have crossed the 18% of GDP in terms of tax GDP ratio. Now, that actually why is this important is because this provides a very stable revenue platform for the Indian economy to take off and solidify its position as a global growth leader. We also come to the issue of how the budget has established a balance in terms of reducing the fiscal deficit while maintaining a real GDP growth, possibly at 7% plus. Now, to be able to do that, let's look at the expenditure side of the budget. which is there in the next slide. Now here what we see is that revenue expenditure growth is limited to 3.2% in FY25. This is shown in the last column of the table. And the second row in the last column here. So if you look at the longer term picture, I mean, if you look at the last 3 years, what we see is that revenue expenditure growth has fallen sharply from 7.9 to 2.5, 7.9 in FY23 to 2.5 in FY24, and increase only marginally to 3.2 in FY25. Now it's notable that revenue expenditure is something that is very difficult to control because part of it is interest payments. And as you can see, interest payments share in revenue receipts is almost close to 40%, as you can see in row 13. So interest payments occupy a significant share in revenue expenditure as well. And therefore, as long as we have a high debt GDP ratio, we need to provide for committed expenditure on account of interest payments and besides pensions. Therefore, to limit revenue expenditure growth at 2.5% and 3.2% is quite commendable. Now, this constraint on revenue expenditure provides the leeway to increase fiscal space for undertaking a higher capital expenditure growth. Now, when we compare FY25 budget estimates vis-a-vis FY24 budget estimates, capital expenditure growth turns out at 16.9%. Now, this is in row number 8, last column. Now, here I would like to clarify that the number of 11% that was even stated by Honorable Finance Minister in a budget speech, that number represents increase in FY25 budget estimate over the FY24 budget estimate. But if we look at if we take the base as revised estimates for FY24, which would be closer to the actuals, then the FY25 budget has provided for an increase of close to 17% over the revised numbers. Now, this is slightly lower than 28.4%, which is the growth in the previous year. But although it is low, it's not lower by a large margin. In fact, 28.4% is itself slightly lower than the budget estimate for this year, which was close to 37%. Now, this 28.4% has enabled a growth of 7.3% in this year. Therefore, one might assume that close to 17% growth in capital expenditure in FY25 might help us achieve a growth that is close to 7%. Now, there are other supplementary factors also that have been that would assist the government in this process. For instance, the scheme to support state level capital expenditure growth in terms of interest-free loans to state governments has been extended for 1 more year with an additional capital outlay of 25,000 crore. So the total amount has increased from 50,000 crore in FY24 to 75,000 crore in FY25. Now, some support is going to come from the state side as well. Now, also when we see that when the fiscal deficit is reduced, government's claim on market borrowings also gets reduced and fiscal space gets created for eventual reduction in interest rates. And this may help bring in private sector investment in the latter part of the fiscal year. From here, we move on to achieving budgetary balance, which is in the next slide. Now, as you see that that budgetary balance is being achieved by a combination of net tax revenue. So now I focus on the FY25 budget estimate column, which is the 4th column, and net tax revenues, which is what the central government gets from out of gross tax revenues after providing for the share of states. Now, this is 7.9%. It's given in row 2. The other components on the revenue side are non-tax revenues and non-debt capital receipts. Together, non-debt receipts are now adding to close to 9.4% of GDP. So fiscal deficit, therefore, when it is brought down to 5.1%, would still enable us to finance total expenditure of 14.5% of GDP, which is broken into revenue expenditure at 11.2% and capital expenditure at 3.4%. Now, here we can clearly see the quality of expenditure has been improving. So, revenue expenditure has been falling from 13.6% in FY22. It has been falling steadily to 11.2 in FY25. And capital expenditure, on the other hand, has been steadily rising from 2.5 to 3.4 over this period. Now, this reflects very prudent fiscal management. Therefore, the overall management of fiscal aggregates is such that we are able to show to the world that we are well on the fiscal consolidation path after having suffered the COVID shock, which was exogenous in its roots. Now, we now study the longer term paths of fiscal deficit in the next slide. Right. So now this chart here shows the downward trajectory from the COVID shock of gross fiscal deficit relative to GDP. You can see that it's going down incrementally from 9.2% in FY21 all the way down to 4.5% in FY26. So this represents the glide path. 5.1 is budgeted for FY25. Now, this is what enables the union government's debt GDP ratio, which is shown on the lower right hand table, to reduce from 56.9% in FY24 to 56% in FY25. But the consolidated debt debt numbers are sourced from the IMF that still remains high at 82.3%. And there was recently a debate about the IMF saying that under a stress scenario, India's combined debt GDP ratio might even exceed 100%. But I think the kind of trajectory that we are following, if we are subjected to a major exogenous shock, we would still not reach that kind of a stress scenario. We have sound fundamentals in terms of growth as well as the kind of fiscal consolidation that the government has been attempting. Now we have also established positions where we have not given way to any major social sector giveaways, focused on fiscal consolidation, and which will provide a background for maintaining robust medium-term growth. Now I will just take a minute or two on the next two slides. Right, this slide on social sector spending indicates that the increase has been provided to major social sector schemes has been extremely marginal. In this sense, it is not a conventional pre-election budget, and therefore it represents fiscal responsibility. Now, the final slide is on major subsidies, which has been a major achievement for the government. And here, I would like you to focus on the numbers from FY16 to FY20 and from FY22 to FY25. What FY21 is the COVID year where the major subsidies share in nominal GDP shot up to 3.6%. Now, what we see is a major achievement of the government over here, because subsidies as a percentage of GDP used to exceed 2% prior to FY16. And the government has brought this down to 1.2% in FY25, which is nearly equal to where we were prior to COVID. Therefore, what I would say is that in conclusion, that the budget has been able to maintain a robust and healthy balance between fiscal consolidation and growth. Thank you.
Thanks, Tarrung, for wonderful insights on the economy. I'm sure everyone found it interesting. At least I found it quite engaging. Good morning, everyone. Now we'll talk about the direct tax proposals. As it was the interim budget and more on vote on account, we didn't have significant changes. One theme agenda of the government has been to improve the taxpayer services and focus upon the core pillars of trust, technology, tax certainty, tax simplification, and rationalization. I think that's the theme agenda that the current FM and the government are working towards. and it was reiterated by the Revenue Secretary as well in his interview post the budget. So one of the rationalizing measures which was to withdraw outstanding direct tax demands uh, for up to financial year 9-10. All outstanding demands of quantum up to 25,000 would be withdrawn, drop, or would it become nil. And from financial year 10-11 to FY 14-15, outstanding demands up to rupees INR 10,000 would be squashed or withdrawn. Now, this is a welcome move. All the pending old irritants, for which data is not available, or given that the department, systems are not updated, uh, this is a welcome move for all SSEs. As you would be aware, in this year's budget, there was no memorandum, and this amendment did not bring a mention in the bill. What we are given to understand that the conditions are getting worked about, and the government will come out with the exact details in the next couple of months. But what the Revenue Secretary went on record to say that the larger benefit that one as an SSE would be capped to INR 1 lakh rupees, so that the benefit per SSE would be restricted. We don't know the overall outflow from a government standpoint on this, but understand that approximately 1 lakh, 1 crore taxpayers would get benefited from this measure. Moving on, there are a lot of talks around various benefits, incentives which were getting lapsed on account of sunset clauses on 31st March 24. So they have been extended. One of those benefits is around to startups. Section 80 IIC talks about 100% deduction available for eligible startups for any 3 of the consecutive years, beginning of the year in which the business has been commenced, provided that the eligible startups has been incorporated on or before 34 March 2024. This is a welcome move. The eligible startups benefits has now the sunset clause has been extended to 31st March 2025. This is in line with the government's focus on innovation startups. So this is again a welcome move. Having said that, there was another benefit. Can you move to the next slide? Regarding the new manufacturing companies, 115 BAB. There was a lot of buzz around the extension of the concessional tax rate of 15% for new manufacturing companies will also get extended beyond 24. However, the same has not been extended. And what we understand, the Revenue Secretary in his uh, conference post has mentioned that significant time were given to the assessees. This provision was brought in 2019 for a period of 4 years. Subsequently, because on account of COVID, got further extended, uh, and unlikely that this is going to get further extended, uh, given the fact that India already now taxes corporates at the rate of 22%, which is in line with global. So more or less, I don't think we'll see any further concessional tax rates for setting up new manufacturing facilities in India. Tax collection at source on the liberalized remittance scheme was brought in last year, which created a lot of hue and cry. So there was a subsequent circular of 30th June 2023, circular number 10, which was introduced, removing difficulties in implementation of the TCS rates on various LRS payments. The change has brought in to codify and incorporate into the law uh, LRS for medical and education expenses up to 30th September 2023, nil up to INR 7 lakhs, 5% for payments beyond INR 7 lakhs, rates beyond 1st October 2023, which has now been codified, a nil up to rupees 7 lakhs, 5% for payments beyond 7 lakhs. LRS for any other purpose other than medical and education expenses up to 30th September, it is nil up to 7 lakhs, 5% beyond 7 lakhs. And from 1st October 23, about 7 lakhs, the payment is 20%. And purchases of overseas tour packages up to 30th September, it was 5% without any threshold. Beyond 1st October 2023, it is 5% up to INR 7 lakhs. So that's the change. And beyond 7 lakhs, it is 20%. Having said that, there are a lot of expectations from the budget, especially around, streamlining of capital gains tax or on a simplification of withholding tax regime. Uh, Given the fact that, capital gains, there have been various provisions, there are depending upon the nature of asset, residential status, period of holding, long-term, short-term, availability of indexation. There could be an exchange rate adjustment if it is related to non-residents. The tax rate could vary depending on long-term, short-term, depending on type of the asset and so on and so forth. Certain availability of grandfathering is also available. Uh, However, that is missing. What we get a sense is that probably in the July budget, we could expect certain relaxations and streamline, given that it is the agenda of the FM stroke the government, to improve taxpayer services and simplify the taxation regime. So we could look at certain reliefs in the upcoming budget post the elections. Similar for the withholding tax, currently the tax regime presently has over 30 sections dealing with payments to residents, withholding rates right from as low as 0.1% and going up to 30%. So that's probably creating a lot of compliance burdens and complexities on account of characterizing disputes, etc. So what we see is some rationalization and some changes to simplify uh, the taxpayer. One could see some relaxations and simplifications in the budget, which is upcoming in July. Hoping to see some change. Uh, Moving on, I think I just thought I'll cover certain changes which were got notified in the income tax forms, and these forms have come well in advance. ITR2 typically, which is applicable to HUFs and individuals who are not eligible to file ITR1, has been notified. Key changes pertaining to earning taxpayers earning more than INR 50 lakhs or having more than one house property shall need to file extra information in the returns. Details regarding legal entity identifier. This is something where an SSE has refunds more than 50 crores. This is a 20 symbol code which is based on global financial systems, and it is mandatory for crediting refunds more than 50 crores. Details pertaining to contributions made to political party donations, etc., will have to be now provided in the return. Details of deductions in respects of maintenance of medical treatments of a dependent who is a person with disability will also now have to be disclosed. Individuals or HUF subject to tax audit earlier could were required to verify the return using DSC. Now they would be eligible to verify their returns using electronic verification code. Similar changes have also been notified for ITR 6. There are certain other additional changes which are being notified in ITR 6 are, and I'll quickly run through, and they are not on the slide, but I just thought I'll cover that as well. Information pertaining to capital accounts scheme is also now being forming part. New schedule for Section 80 IIC seeking details of eligible startups have been introduced. Disclosures for some payable to MSMEs beyond the prescribed limit, which was introduced last year under Section 43B, is now those details will have to be mentioned in the return. The new schedule has been introduced to seek details for ATLA, which is about offshore banking units of IFCs. Winning from online games chargeable under 115 BBJ also will have to be disclosed under a new disclosure. Dividend income derived from a unit in IFC will have a separate disclosure and reporting under the new ITR 6. Companies will have to now specifically provide the due date for filing ITR 6. That could be October 31st or November or September, as the case may be. Company which is recognized as micro and small enterprise will now have to furnish details along with the registration number allotted as per the Micro, Small and Medium Enterprise Act. So these are the quick changes which were pertaining to the various ITR forms which have been notified. With there, I think we conclude on the direct tax budget changes and recent proposals. We would be happy to take any questions that the audience may have. Sanket, me, and Tarrung will be happy to address any questions that may be there.
Thanks a lot, Rahul, for this detailed update on income tax and very interesting insights on this. Although we may imagine that in this interim budget there was hardly any changes, but still there are certain important points to note, nevertheless, for everyone.
True.
And we have to watch out for July now.
Yeah.
Yeah, I don't think we have any specific questions on the chat box. So
do we
there
have
are
any
no questions.
questions
Yeah.
from the audience?
Yeah, no questions, I think.
No questions as of now, we suppose. So in case anyone has any questions, they can write to me. I'll share it with the EY team and we'll try our best to resolve your queries. Thank you so much, EY team. And this was really an insightful session. At least I gained a lot, and I hope our audience also gained a lot. So we look forward to more such sessions together. And a heartfelt thanks to you. Thank you so much.
Thank you very much.
Thank you, Arya, and thank you, everyone.